What's up, apes? Welcome back to the 𝗪𝗚𝗀𝗀𝗀 daily podcast of the day. Thank you all for tuning in once again because we have a jam-packed edition for you today. As always, we're going to be talking about the botched treasury auctions that seem to be plaguing the United States in the post-COVID era, what that means for Uncle Sam and why he's officially shifting into subprime borrower status. And we all know how that worked out the last time, that being a subprime borrower became relatively popular. We're also going to be talking about some of the biggest stock movers of the day, including NVIDIA, Robinhood, 𝗵𝗡𝗪 Financial, and goddamn JetBlue, who just completely fell apart. So stay tuned to get our full thoughts on all of those stocks. Then, of course, we'll finish up with a recap of earnings season so far. So if you're at all interested in seeing how the market has been reacting to the earnings numbers that companies have been presenting this quarter, make sure to stay tuned till the very end. Of course, my name is David. It is currently 6:30 p.m. on this beautiful Monday, August 12th, 2024. Like I said, we got a lot to talk about here, so let's just go ahead and get right into it. First of all, not a great day for the WSO Alpha portfolio. We lost about 32 basis points for the session today, so definitely not a great session, but in comparison to the indices, it could have been a whole lot worse. Now, if we go ahead and take a look at what some of these names did for the day, the S&P and the NASDAQ completely smoked us. So the NASDAQ was up 21 basis points and the S&P was flat, basically 0.0%. It wasn't unchanged because it did move 23 basis points, or 0.23 basis points, actually, I believe it would be. So not an unchanged today. Those unches are always electric because they happen so rarely, but not an unchanged session, 0.0%. The Russell 2000 small cap index was down 90 basis points. So we outperformed the Russell, which is kind of like beating a 5-year-old in a foot race, but still we will take the win for the day. So WSO Alpha down 32 bips for the session, up 6.41% for the year. I promise, we have been beating in the last 5 years, the last 10 years, since inception, like every key metric besides year to date. And so it's really annoying that we can't showcase this as soon as we started to showcase the year to date performance, which only began in 2024. But nonetheless, we're here to ride it on out. So make sure to go ahead and subscribe to WSO Alpha if you want to ride it all out with us. Okay, let's go ahead and get into some of the banana bits for the session. First of all, I was so excited to log into the Wall Street Journal this morning because really the article that we've all been waiting for has finally been published. The Wall Street Journal did a very deep dive on the working hours in banking and specifically focusing on Bank of America, given the recent passing of a hero, a Green Beret of the United States, an absolute hero of this country, was, unfortunately became deceased because of his role, or somehow linked to his role at Bank of America through, working 100-hour weeks and just the stress that puts on your cardiovascular system. So the Wall Street Journal did a very deep dive into this. Make sure to go read that article. Subscribe to the Wall Street Journal just to read this article if you don't have an account already. But if you don't have an account to the WSJ, you're probably not watching this video, let's be honest here. Nonetheless, go ahead and check that out. Leave your thoughts. Make sure to share it with friends, colleagues, whoever you possibly can. Really, anybody that can read, quite honestly. So everybody besides me, basically. And share it with them so that we can actually be the change that we want to see in the industry. Nobody wants to work nobody wants to work an 80-hour week, to be honest with you. I think an 80-hour cap would be reasonable because that's fucking insane to work 80 hours per week. But a lot of people seem to be used to it, and it's a hell of a lot easier to do than a 100-hour work week. Go ahead and check out that article, please. We've been waiting on this one for quite a while, so make sure to go ahead and click through and read that stuff. Meanwhile, markets have been a little bit jittery this earnings season, more jittery than usual. We'll break down the exact numbers in just a minute towards the end of this video. At the same time, U.S. unemployment, the situation in employment isn't as much of a situation as we may have anticipated. If we actually read into the numbers a little bit, then things are looking a lot better than the headlines would have you think. So go check that out. The Somme rule, quote unquote rule, may not come into effect this time as it's been successful in the past. But I mean, really, these economic rules, like even Claudia Somme, the woman whose name is behind the rule, you can't look at just one thing and say this is the correct answer. I mean, Harvey Campbell said the same thing about the yield curve inversion, which was his discovery. So, don't rely on just one economic factor. Yes, the Somme rule is still in place and the yield curve is still inverted, but, we'll just forget about that for now and pretend it doesn't exist. Meanwhile, rising monthly prints may be gone, but the nutshot of inflation still looms quite large. So we're kind of past the point of seeing, slowly or really quickly steeping inflation prints on a monthly basis, but the cumulative effects are still very much in place in all the wrong places, including things like shelter costs, including things like rent and mortgage payments, mostly due to interest rates, of course, And then childcare, food, groceries, basic things that you need for a civilization to survive into the long term is still pretty fucked. So make sure you go and see how fucked that is. Again, I think that's a Wall Street Journal article. And then finally, go trees, apparently. I have no idea why Stanford picked like literally the worst and most boring mascot I could possibly imagine in a literal tree, but still, Stanford University, very impressive at the Paris Olympics this year. The college itself took home 12 medals in total, which is more than most countries did. So I think if we rank like all the countries and then throw Stanford in there, I think it would be like the 10th most medals at the entire Olympics. So very impressive job from the trees over in California. So thanks, you guys. I'm laughing at your logo, not your performance. Trust me on that. Oh, and by the way, most of you, a solid 63% of you, think that the inflation print for July, which is going to be coming out tomorrow on Wednesday, most of you think that that's going to be lower than the 3% figure, although it was a relatively close split. It was about 63% and then about 30% for higher, and the remaining, 7% or so was for the same at 3.0%. I don't know who thinks it's going to come in at the exact same reading. That's a pretty, ballsy gamble, but nonetheless, that's what you guys are thinking right now. Make sure to answer the daily poll in tomorrow's daily peel of the day. Okay, let's go ahead and get into our main story for the session. So we are talking about untreasured treasuries in our macro monkey here today because the treasury market has been getting less activity than my old dating profiles used to, which is fucking saying something. Like, let me tell you. And to be honest, neither one of us should be as surprised as we were when these were all going on. The United States, it's very hard to want to lend to somebody who's in, debt that looks like this. So for those of you that are listening to us on the podcast, we take the screenshot of the upper left-hand corner of the nationaldebtclock.org website. And what you're seeing right here is that when I took the screenshot, we had, I'm going to read the number, we had $35,152,389,003,557 in debt. So that's the current situation of the United States. That sits at about 123% of GDP, just a little bit below that full 122%. And is an absolute explosion from our historical levels. So why would you want to lend this guy money? If your friend came to you and said, hey, I make $100,000 per year, but I'm also $150,000 in high interest debt that is variable and continuing to rise, would you want to lend them money? Probably not, but maybe if they're a really good stock trader or something, obviously remortgage your house and give them money to invest in the market for you. But still, typically you wouldn't want to lend money to somebody like this, so we probably shouldn't be too surprised. But if we go ahead and take a look at the treasury auction process, basically the way that it works is that when the United States is looking to raise money and they decide they don't want to go rob your wallet any more than they already have for the year, when they're not doing so through taxes, in other words, they will issue debt, and they do this on a very regular basis. The Treasury has it all figured out. It's a very pedantic, complicated process, of course. But to simplify as much as we can to gain the understanding that we need here today, basically, the way that the Treasury auction process works is that when the U.S. government decides that it's going to be issuing new bonds of a certain maturity, it essentially gives a when-issued bond. So it's as if they were to issue a bond, but it's fake. It's fugazi. It's fairy dust. It's not fucking real. It's not on the elemental chart. They issue this when-issued bond so that the market can kind of play around with it, almost like you're trading a paper money account, and they can get the market-based pricing in so that when this goes to auction, they can start at a point that the market will at least respect. So when they do that, the when-issued yield, or the yield before going into the auction, is kind of like the expected yield. It's like the consensus estimate of what the yield is going to be. So when yields come in higher than that, when the auction yield comes in higher than the when issued yield, that is a sign that the market is not, the market's appetite for treasury yields is not as high as was expected. And if we go ahead and take a look at this chart from Certified Smarty Pants, Torsten Slok, the chief economist over at Apollo, this highlights just how crazy it's gotten in recent years. So what we're looking at here is called the auction tail. Now, an auction tail is the spread between the when issued yield and the auction yield. So if we look historically back in 2020, 2021, most of these tails are negative, meaning they're oversubscribed, meaning that the auction yield comes in lower than the when issued yield, and that means that there's more demand that's pushing the price higher and thus lowering the yield. But right around when the Fed started to raise rates, the script completely flipped, and really nobody was oversubscribing to these whatsoever. So what we just saw was a 3 basis point difference in the when issued yield and the auction yield, aka a 3 basis point tail. Now, 3 basis points, you're going to say, David, you're not freaking out over 3 basis points, right? Come on, you're a very rational, wise, intelligent, handsome, athletic man. You wouldn't be freaking out over only 3 basis points, would you? Absolutely, I'm freaking out over 3 basis points. I'm gonna fucking call my mom and move to Finland if I have to. Like, Jesus Christ, this is absolutely terrifying. The really scary part is how clustered they're getting. Volatility does tend to cluster, and most things in markets tend to cluster, really. And so the concerning thing is that the large tails have become more frequent, and they're continuing to increase in their frequency as we go forward. So the concerning part there is that the market is basically saying, we don't want to lend money to the US government. Now, that is like we could take 10 daily peels and we wouldn't have enough room to explain exactly how concerning that is. Now, the headline concern is how that's going to impact the fiscal spending of the US government. It just means that the government won't be able to fund itself. We might be looking at more government shutdowns in the future, especially if we get a Trump presidency. We all know that he will shut down the government much more freely than, really any Republican will be much more willing to shut down the government to show that they're fiscally conservative than the Democratic Party. So that wouldn't be much of a surprise there. So this is the concern that's going on right now. But at the same time, despite the fact that auctions are pushing yields higher, trading yields continue to move lower. So this is the past 3 months. Just a couple of days ago, we were at the lowest print. That was following the Fed's latest meeting, as well as the jobs report that basically guaranteed that we would see a September rate cut. So the famous quote of, if you're not a little confused, you're not paying attention, has never been more applicable than in the Treasury market right now. Investors don't want to lend money to Uncle Sam directly, so it seems that the secondary market is becoming a little bit more popular so that we can yield farm in something that isn't fucking virtual pictures of goddamn apes or whatever the fuck people were yield farming back in the day. This is yield farming risk-free rates from the United States government, so it's a little bit different, but still, the basic idea is that we don't want to lend directly to the US government, but we do want to earn that yield. So there's kind of this weird balance going on right now where investors are worried, so they want to buy US assets because those are typically the safest in the world. But given the fiscal and macroeconomic condition of the United States right now, you'd be hard pressed to find somebody that wants to lend to that borrower. So effectively, this is going to lead investors to demand higher rates at these auctions. That's going to make interest payments on US debt harder to make because it is variable interest rates for the most part. That's going to worsen financial conditions in the US even more, making investors demand even higher yields, thus making the payments even harder to make, and yada, yada, yada. You see where this is going. You definitely don't want to be here when shit hits the fan, if shit does hit the fan. It seems like we just need to curb spending, I can't believe I'm going to say this, but raise taxes, do anything to balance the budget, just do anything to try to balance the budget or show that you're even slightly concerned about it. Fuck it. I mean, Congress people are already insider trading like fuck. Let Janet Yellen do the exact same thing and just ride the buy Nvidia, ride the fucking stock market, do anything, buy Bitcoin, but place bets on the fucking MLB games or whatever it takes. Just get us out of this situation. That's going to be my rant for the day. Let's go ahead and move on to some of the big stock movers. So starting out with what's right. Speaking of NVIDIA, we have NVIDIA shares up 4.1% for the session. We still haven't discovered the fountain of youth, but we absolutely have discovered the fountain of wealth. And who knew that it's spelled NVDA? This thing just absolutely keeps ripping. It's giving 𝗟𝗡𝗄 a run for his money in terms of the biggest money printer in the United States, quite honestly. But really, renewed optimism emerged as analysts started to upgrade their ratings on NVIDIA based on renewed price targets, driven by the spending figures that a lot of these companies are revealing in terms of how much they're investing in artificial intelligence capabilities. We know who the number one beneficiary of artificial intelligence spending is going to be. It's going to be NVIDIA. And so given the fact that Meta comes out and says we're going to spend fucking $40 billion on AI chips over the next year or so, that's bigger than NASA's budget, by the way. NASA gets about $33 billion. So Meta is spending more on AI than NASA gets. Total. So absolutely insane. We know most of it's going to NVIDIA. So analysts were kind of taking this in and saying, some had moved their targets to neutral or like buy instead of strong buy. And so they're kind of going back up the chart there. The biggest one to do so yesterday, I believe, was Piper Sandler. Now, you're not supposed to see that chart yet. Moving on down to our second What's Right mover of the day, we have Robinhood up 3.5%, one of the biggest beneficiaries of NVIDIA doing well, not on the fundamental side, but on the trading side, because this company saw total revenue up about 22% for the quarter. Now, exchange-based revenue was absolutely exploding. Transaction-based revenue really Actually, it was 40% total revenue growth. Excuse me, I mixed my numbers up a little bit there. It was 22% growth on their non-transaction based revenue, but 40% overall growth in Robinhood's revenue for the quarter. Most of that was driven by digital asset trading, or I can say it on this, crypto trading was up 161%. Now, that's not activity, that's not profits, that's revenue from Robinhood. That's what they're gleaning off the top of all of your crypto trades on that platform. Keep in mind, not your keys, not your coin. So I don't know why the fuck you're trading it on Robinhood. Well, trade it on there, but take it off exchange. Actually, can you even take it off exchange on Robinhood? If you're trading crypto on Robinhood, please don't. That's my big request for the day. Equities revenue grew 60% and options revenue were up 43%. Needless to say, the firm absolutely destroyed estimates, and they got some of their own upgrades in their ratings as well, moving up to overweight at Piper Sandler once again. All right, moving on down into the what's rotten, stinky, smelly stocks of the day, we have B. Riley Financial. This was an absolute massacre of the likes we haven't seen since Boston in 1774. The stock was down 51.9% for the session. Absolutely disgusting day. Everything went wrong for this company. Like, there's good earnings reports, there's bad reports, and then there's fucking B. Riley. They decided not to do a report at all. They delayed their filing because they're having some trouble coming up with valuations on a lot of their loan books. Specifically, there is one loan that's particularly bad to the CEO of, I forget the name of it. I think it was Frontier Group. They loaned him money so that he could buy back the company, and it didn't go very well, apparently, because B. Riley, see again, is down 52% for the session. But nonetheless, they also delayed their quarterly filing. They suspended their dividend, and they issued new guidance on earnings per share for the ongoing quarter, now expecting it to come in at a loss of $14 to $15 per share. Absolutely horrific earnings report. I think that's somewhere in the realm of about $500 million in total. So very disgusting day for B. Riley Financial. The other factor being, I had a friend that used to work at B. Riley and he actually quit recently. So the market must have found out that he quit, and just, why would you own the company at that point without him? That guy really was him. Trust me. Moving on down into the last stock mover of the day, we have JetBlue down 20.7%. This company, they had some interesting news reports that dropped over the weekend, but who knew that breaking a passenger's ankle with a seatbelt wouldn't be the worst of their news for the weekend? Now, how you break somebody's ankle with a seatbelt, I really don't know. I would love to see the cell phone videos of that. I think we need physicists to go in there and study that to figure out how the hell that's even remotely possible. But still, JetBlue didn't want to let passengers hold all the pain, so they decided to pass some of that suffering along to shareholders in the form of huge financing raises. So the company is raising $2.75 billion in pure debt offerings and another $400 million in convertible note offerings. Convertible note, aka, means debt now, equity later. So this is very dilutive to existing shareholders. They threw up, didn't like it whatsoever. Stock's down 20.7%. They also got a downgrade from Moody's at the same day, so all of this kind of amalgamated into yesterday's sell-off. Okay, moving into our Thought Banana session of the day, we are talking about the only thing that matters, and that is, of course, earnings report. We talk about heroes in society quite a bit. People like veterans, police officers, nurses, financial newsletter writers. All of these heroes of equivalent valor have something in common. And one of those things that they have in common is that for most of the day, for most of your, professional life during the day, there's not really a whole lot going on. It's more like just kind of passing time. And then all of a sudden, everything happens all at once. So these absolute heroes, I don't know how they do it, but they somehow take all of this, everything happening all at once, and figure out exactly what's going to be the important thing. So for the absolute virgin, the heroes that are financial newsletter writers out there, the past couple of weeks really has been everything happening all at once. So I don't blame you if you've been getting bogged down in the news cycle, because there's been a whole lot going on. But today we want to reframe and focus on what actually matters, and that is, of course, earnings. So if we go ahead and take a look at the first chart that we have right here, this is giving you a summary on earnings so far. At this point, 91% of S&P 500 companies have dropped their numbers for the quarter so far. And just to give you some of the headlining figures, on the EPS side, the bottom line, 78% of companies have beat their EPS estimates, and this is above the 5-year average of 77% and above the 10-year average of 74%. But the average degree of the beat has come in at only 3.5%, which is well below the 5-year average of 8.6% and below the 10-year average of 6.8%. At the same time, for earnings, if this growth rate holds true with the remaining 9% yet to report, if that holds true, the EPS growth rate will be 10.8%, and that will be the fastest that we've seen since the fourth quarter of 2021. Moving on to revenue, as we can see in this next chart here, Again, 91% of companies reporting, 59% of these companies have beat their revenue estimates. That is below the 5-year average of a very nice 69% and the 10-year average of 64%. Now, the average revenue beat in Q2 sits at a measly little 0.5%, while the 5-year average sits at 2% and the 10-year average is at 1.4%. With that being said, if that if this was to hold for the whole quarter, for the remaining 9%, the year-over-year revenue growth rate would come in at 5.2%, and that would be the fastest that we've seen since the fourth quarter of 2022. So that's a lot of numbers. What the hell does all of this mean? Well, first and foremost, companies have done a really good job in managing their costs and their share count to deliver growth in EPS. That is crucial for shareholders, and companies have done a great job doing so. Now, the lower magnitude of revenue beats in particular could be a sign of concern. This could be signaling weakness in economy-wide demand, and that could spook investors a little bit. But still, given that it's one of the fastest growth rates in a year and a half, or the fastest growth rate in a year and a half, this, I think, speaks more to overzealous estimates from analysts, and we can see this on the bottom line with EPS as well. Earnings per share beat by less than their average, but the amount of companies that beat is still outperforming the average. So still, it was a relatively good quarter, plus it's very fast growth, the fastest in 2.5 years, so still performing fundamentally very well. The problem is analysts were expecting too much. So what we're seeing right now, the pullback in markets that has coincided mostly with earnings season so far, at least since the end of July, is really a valuation-driven pullback. And that's relatively good for investors, especially long-term investors, because when valuations decline, or when they finish declining, I should say, who knows when that actually is, you can't really tell when they're going to be finished declining with foresight, but you certainly can with hindsight. But when valuations fall, expected returns in the future increase. So this is good for longer term investors. It's not great for the current quarter, obviously, because it's not going too well for a lot of companies out there. But all you young blood apes, unless your companies are completely shitting the bed like B. Riley, probably don't freak out and don't use this as too much of a reason to sell. And let me know if you're buying the dip out there and what dip you are buying. Okay. Let's go ahead and finish it up with our wise investor quote of the day. We are going back to a true legend himself, somebody who passed only months ago. Mr. Charlie Munger passed at the age of 99, just a couple of weeks before turning 100, which he would have done on January 1st of this year. He once said, "No matter how wonderful a business, it's not worth an infinite price." Keep that in mind as valuations continue to recede. If they continue to recede going forward, the Fed rate cut could fuck this whole thing up, but nonetheless, fingers crossed that we don't lose all of our money in the interim period. That about does it for us today. Like I said, guys, thanks so much for tuning in and joining with us. It is now 6:52 p.m. and I'm going to go eat dinner, and I will see you guys tomorrow. Happy investing, happy trading. Bye now.